Hey everybody, this is Paul doing a quick little bi-weekly YouTube update here on the market and what's going on. So I guess let's kind of look at the market. So right now it's November 1st. Market is currently open. Federal Reserve Chairman is currently speaking, but I think he's kind of gotten through all the really important questions that people care about. And if you can't take a guess here, what how people are interpreting what he's saying is basically if if the data comes in hot, so the Federal Reserve Chairman is basically saying if the data comes in hot, we're ready to raise rates again. But as you can tell from the market right here, as you can kind of see what's going on, the market is making a bet, and based on pretty good information, like given the manufacturing numbers that came out today that were extremely weak and almost in recessionary territory, but manufacturing only makes up about say 15-20%. That could have been affected by the strikes and whatnot. So based on that data, the job openings data wasn't as hot as we expected. ADP, which is constantly wrong, and I'm so happy to see them selling off today. So it makes me so happy to see ADP selling off. But ADP, which showed a weaker number, so maybe there's this slowdown going on, and then also you got Q4 GDP just got revised down. So maybe maybe we got this slowdown going on, and it's not going to require any more Fed hikes, even though it's possible that in December they could hike, but right now it's only priced in I think 15% or something like that. So that's what you're seeing here, because everybody's been waiting for that time to jump in the bonds and jump in the stocks, and this is what you get. Um, so I guess let's look at some of the data that we have here. Let's see. So this chart right here will back up once it opens. Um, this chart right here will back up why everybody thinks the Federal Reserve is done. So this is based on just apartment list, which is a website which has pretty much all the apartments in the country on it. Um, so as you can kind of see, CPI did not really count correctly, rent inflation at all. And then as you can see, rent inflation has actually turned negative. This is not reflected in the current CPI report. Um, so if we go over here, so this is another thing too, for example. So this is Eurozone inflation. They're effectively in a recession, but they refuse to admit it. But as you can see, their inflation numbers are just flat out crashing. Um, and what's kind of messed up is basically as demand falls on in Europe, it increases supply everywhere else in the world. So it actually causes inflation to come down even faster too, because people want to push out products. Um, so this is kind of an interesting thing. So this is just more European data, just showing basically effectively deflation now in certain parts of Europe. Um, and then we just got different data points that are kind of pointing towards inflation's coming down. Also, what's going on today is the Bank of Japan came out with this. So if you want to pause, effectively the Bank of Japan said they're going to let they're not going to try to intervene as much, I guess is what they're trying to say, but it's so weird. They're not going to raise rates themselves, but they're going to try to intervene less, is what all of this says, I guess. It's so weird. But anyway, so this is how the Japanese markets took that information, that they're not going to raise rates, even though their inflation's starting to take off. So our markets reacted to that immediately because we have a lot of Japanese investors and pension funds and stuff like that. So that's one other reason why the market is just kind of taking off to the sun right now. Also, earnings have not been that bad. Some of them are up 12%. The big seven stocks have all beat their earnings. Some areas were weak in certain specific companies, but others were just like Meta, for example, was really, really strong. So, just what happened in October, is effectively starting to get reversed at the beginning of November. It's just what happened in November is basically there was a bunch of treasury issuance, or October, there was a very large amount of treasury issuance, and the 10-year took off towards 5%. And the curve actually almost uninverted, which means that the 2 year almost became worth less than the 10 year, which has not happened in quite a while, given how inverted this market is right now. Uh, so we have just the 10 year that just took off, and that's the one that the market really pays attention to because that's where companies like to refinance their debt very as far out as possible. So when that took off, it took down the entire market and just hammered everything. So as you can kind of see, so if I don't include, so for example, if I don't include any numbers from today, you get something like that for the month of October, which I actually need to record that number. Um, so I could do that actually now. But, for October, as you can kind of see as I put numbers in here, now this does include also I did have to do repairs to my car. I got 4 new tires and an oil change, so it's actually down about 1,000. And then also on the dividend side, one of my one of the funds reduced the dividend in the month because of the low returns of the market. So it was this one right here. It's based on market returns and their ability to fund it. So they reduced it, but they typically end up putting it back up, and when the market kind of goes up. So I'm not too stressed about that. But so this is currently where we're at right now. Um, what do I expect? Um, it depends. It depends what the Fed does. It really does. Um, so eventually the data will catch up with the real-time data, and I think by that point, they're going to aggressively cut rates. Um, because what they fear more than inflation is actually deflation. That's when prices are coming down. And I know, so that's what I was showing here with this survey here, is that even though CPI is down, University of Michigan shows that people are more angry about the economy. They don't like the economy. Well, that's because people want deflation. So what they want is they want 2019 prices, but they also want to keep 2023 wages. That's just not how that works. When deflation happens, wages go down right along with prices. So you don't want that, but that's not something you can easily explain to, like anybody. It's just impossible. So I think right now the market is very bullish. Even some of the biggest bears I've seen on Twitter have turned bullish from being bearish the last few months. And you can kind of see why. If they think the Federal Reserve is done, which everybody has said that for all of October, but all of a sudden everybody's starting to believe them, and this is what you get. Everybody piles in because they want to catch rates at their highest possible point for as long as possible, so everybody piles in, so this is exactly what's going on. Pension funds, hedge funds, everybody piles back in these. If you get one hot inflation report, it could change all of this, but it doesn't look like that's going to happen because of the data I showed you. And then also oil came back off from $90. So the market could have a pretty nice, possibly, Santa Claus rally if nothing else happens between now and then. But so we just kind of have to see. So what am I currently doing with my portfolio? So currently right now I'm not doing any investments in E-Trade. Because they're having trouble paying out dividends correctly. So they're having trouble paying out dividends correctly with E-Trade for some unknown reason, no matter how much I call them. So I'm currently waiting to see if E-Trade kind of gets their act together on dividends. But right now, basically, my obvious buys would be like O, for example. Pretty much anything that I have not hit my targets on. So as you can see, O. Just different things like that. Uh, BBN. This is another one I was supposed to pay out last night but didn't pay out, so I have tickets open with E-Trade to figure that out too. But so that's currently what I'm waiting on. Is before I invest any more money with E-Trade, I kind of want to make sure that they're paying out dividends like they're supposed to. Because currently I have zero incentive to keep money with E-Trade. If anything, I might start reducing my funds over here and putting it somewhere else. So if they can't get their act together ever since they got acquired by Morgan Stanley. So that's currently where the portfolio's at. Um, I'll probably update it with maybe this number right here plus my other fund, and just kind of we'll just go from there. But I think November could be bullish unless the data comes in extremely hot. And it is possible that the data could come in hot because ADP is just never right. So I think we get the jobs report on Friday, and that will show if ADP is completely wrong, which, shocker, they're going to be completely wrong. But if ADP does end up being right, you're going to see another rally. This might push the market to 4,400. If the jobs report comes in very weak, you could see the market push to very, very high, because that would back up the slowing down narrative and the pause narrative and the possible cuts in 2024 narrative, which is what's going on. It's all narrative driven. And then also, if the debt that they issue it on the front of the curve, which is the 2 through the 10 year instead of the 30 year and the 20 year, that kind of stuff. You could see more rallies. So I think that's currently where we're at. So you just kind of have to watch the data as it comes in and just see if it comes in really hot or if it comes in slow. So the market is going to be very data driven from day to day. So you get a really hot jobs report that says 500,000 jobs, and all of a sudden this whole thing right here could be negative 742. So you kind of got to watch this market in time when you want to invest. So I think that's currently where we're at. So let me know what you think, and then leave a comment, and then we'll just kind of go from there. Okay? Thank you.